The US dollar index, DXY, weakened as investors realize that a Federal Reserve official's past voting record does not automatically predict future policy decisions. The phrase "a vote record is not a reaction function" highlights that Fed policymakers respond to evolving economic conditions rather than following a fixed pattern based on previous votes. Markets had initially interpreted the voting history of some Fed officials as a sign that interest rates would remain higher for longer. However, the Federal Reserve has emphasized that its decisions are data-dependent, meaning inflation, employment, consumer spending, and overall economic growth will ultimately determine the direction of monetary policy. As traders adjusted their expectations, the US dollar gave back some of its recent gains. This shift reinforces the importance of incoming economic data over historical policy positions. If inflation remains stubbornly high or the labor market continues to show strength, expectations for tighter monetary policy could return and support the dollar. Conversely, weaker economic indicators may increase the likelihood of future rate cuts, placing additional pressure on the US dollar index. For Forex traders, the key events to watch are US inflation reports, non-farm payrolls, Federal Reserve policy meetings, speeches from Fed officials, and Treasury yield movements. These factors will determine whether the US dollar index regains momentum or extends its recent decline. Stay informed, manage your risk, and follow for more daily Forex market updates.